Very, very sorry. Today we are going to look at, we've been looking at the accounting, the users of accounting techniques. So we are looking at the accounting. Last week we stopped at the historic development of the accounting. We stopped at the historic development of the accounting, and I gave you assignment on that. We look at the accounts payable and other these things. But today, by the grace of God, we are starting from other parts of the accounting today. We are looking at some, we've seen the definition of accounting before. We've seen definition of account. Then we are moving on to, let's move on to next one. We are looking at the quality of accounting information. Quality of the accounting information. What are the quality of the accounting information? We've seen the users of accounting information. So let's go to chapter 3 of that same, users of accounting information. And the users of accounting information, last week we look at it, that the users of accounting information are the government, the customers, the suppliers, the competitors, and most of them like that. And your assignments, you did very well. Today we are looking at the importance of accounting. Importance of accounting. What are the importance of accounting? Number one, we are looking at the importance of accounting. Number one, accounting information can be used for decision making. It can be used for decision making. That means the management would need it to make decision. The government would need it also to make decision for whatever they want to do. So number two, it provides permanent record for all transactions. When you do your accounting very well, it gives you permanent record for your accounting informations. Two, it helps to determine the profitability of a business concern, whether you want to know if your business is making money or is not making money, or you are running at a loss, or you are running at a very good, at a profitable way. Then it shows that. Then number four, accounting records are used for tax assessment. They are used for tax assessment. Then the government, it's the government that bases you on tax assessment, on what your tax assessment should be. So you need to understand that. Then you also need to know that it also helps you in another way, that to make sure that the customers, they want to put their money to the business to run it or not to run it, to run it or not to run it. So let's move forward. Let's move forward. Then we are looking at also measurement of performance. The accounting is used also for measurement of performance. We want to know how much the company is performing, whether we are performing well, or they need to diversify their products. If there's going to be diversification of their products, so they will also know. Then they also need to understand that they want to know if the accounting is liquidated, if is liquidated or is bankrupt. Now, every investment want to check. So it's also useful. The importance is also useful for the account for the investors to know if they are investing their money or not investing their money in it. Now we are moving forward also. We move on, let's move on. And we are looking at the quality of accounting information. What are the qualities of accounting information? Let's look at the quality of accounting information. Now, number one is accuracy and reliability. Accuracy and reliability. The accounting must be accurate. Then the people must be able to rely on it. And that is why the only way to know if your accounting is reliable or is accurate is by the external auditor, signing it and submitting it. Two, discipline. Quality of accounting. There must be discipline, because it has to contribute to the accounting information. Then it makes the management to be disciplined or prudence in whatsoever they are spending, if they are spending well or not spending. Then number 3 is problem solving. Problem solving. They help us to solve problems. Now you'll be able to project or to forecast what to do next and what not to do. Then we also look at efficiency. Accounting information must be efficient. It must be efficient. It must further the interest of the business organization by recommending changes for the development of plans, policies, procedures, and various phases of business operation. And number 5, earning potentials. Now, this is mostly for the employees that they want to know if they are going to call in for more funds to themselves or they are not calling for more funds to themselves. Then number 6, timely. Now, we also know that timing is one of the big problems of Nigerians, and the accounting period of Nigeria, it starts from the accounting period of Nigeria starts from January and end in December, most especially December 20, between December 20 and 30th. It ends there. Then we also look at number 7 of that is objectivity. Objectivities. And accounting information must be objective. It must be specific as to items, facts, and where possible, the effects of reported facts. It must be objective. Now let's quickly look at the importance of accounting information. What are the importance of accounting information? We have seen that it makes up performance and most other things. Now let's move on this morning. We are looking very quickly at some of these, some of the things that we need to know about. We are looking at concepts, the concepts, accounting concepts, principle, convention, and basics and policies. Accounting concepts, principles, convention, and basics. What is concept? When we talk about concept, concept is not a static subject. It is a constant undergoing changes. Concept is constantly undergoing changes. Is financial accounting seeking objectivity of courses. It must have rules which lay down the way in which the accounting activities of the business are being recorded. So when we say concept, we talk about the rules. The rules are used in accounting. Now, these rules are not just rules that came up one day. They are rules that have been there over time, in the seasons of time. The rules have been there. Then, so we are going to look at types of concepts. Types of concepts. We are looking at type of concept. Looking at types of concepts. Number 1, we look at the entity concept. Entity concept. That's number 1 concept. And entity concept, the owner of the business is a different entity from the business entity. When we talk about business and the entity concept, we are talking about the owner of the business is different from the owner of the business. So the business is an entity on its own. The owner of the business is an entity on its own. Now, the only time that the owner, that means the business can be sued and the business can also sue someone. Now, so when we talk about the entity, that means the man's business is different from his own personal self. So we call it the entity concept. And we must be able to differentiate the asset of the man from the asset of the organization. B, going concern concept. We talk about the going concern concept. Now, the going concern concept assumption here is that the business will operate in perpetuality. The business will operate in perpetuality. That means on a continuum. The business will continue on a continuum. So if the business is going to continue on a continuum, then there must be a way of putting the business into place so that the business can continue to run on. That is, business is not expected to liquidate in the foreseeable future that is growing. So we talk about the going concern concept. That means the business will continue to wax great and wax strong. Then we look at number 3, the periodicity concept. Periodicity concept. That means result of business units cannot be determined with precision until it is finally liquidated. So users of accounting information require that business be divided into periodic, usually 1 year. That means from January to December. And at the end of December, every business must fax their statement of account. They must fax their statement of account. Then number 4, realization concept. We look at realization concept, that this concept establishes the rules for the periodic recognition of revenue as soon as it is capable of objective measure. What we are saying is that the concept establish the rules for the period recognition of revenue, what is coming in, what is going out, it must be measured. And how do we measure the concept? This concept, we measure it by the cost. We use cost in measuring it. So that is, it is capable of objective measurement. That's what can we use to measure that, okay, the business assets, the liquidation, the liquid assets and others. So we do use the realization concept. Now, also the value of assets received in exchange is reasonable certain. You know the value of what you have, how much you have. Then that's why at the end of every year, there's what is called the the statement of account for the end of the year that is being done at the end of the year. So this concept holds it. Then we also have the matching concept, the matching concept, the matching concept. This concept ensures that revenue of a period, say a year, must only be matched with incurred costs of the period. That means for income, your income and your expenditures, that means they have to match each other. So if they don't match, there's problem with the account. Or for any accounting period, the end revenue and all the incurred costs that generate that revenue must be matched and reported for the period. And I've told you what you use in matching this concept is money. It is money, it's the cost of what you are. Now we also have number 6, historical cost concept. Historic cost concept holds that cost is appropriately based for initial recognition of all assets, then acquisitions as render or received, expenses incurred, and creditors. What that place is saying to us is this. It's very simple, that based on the cost of the previous year, we can easily know or determine what this year is going to be. That's the historic. That means, and also the cost of yesterday does not change. If you are going to make any inventory for this year, the cost does not change at all. Then all these things also, they are also to the owner's interest. The owner's interest, what the interest of the owner is on the business. And when we talk about the owner interest, and it also holds the subsequent to acquisition costs, value are retained throughout the accounting or processes. Then simply put, assets are normally shown at cost price. That exactly. Assets are normally shown at cost price. And this basis for assessing the future usage of the asset, we know. And we know that cost of assets do grow up or do go up all the time because asset is fixed. So, but we always refer to the cost of the asset. When we refer back to the cost of the asset in the previous year, we talk about the historic concept. Then the number 7, consistency concept. Consistency concept. Usually, there's more than just one way in which an item may be treated in the account without violating accounting principles. That means accounting can be treated in several ways without violating accounting principle. But what we are saying here is this. This concept holds that when a company selects a method, it should continue. It should not just be changing method, like you are changing method today, tomorrow you are changing another method. No, we don't want that. It should not be the things that we are talking about. So we talk about the consistency concept. Talk about the consistency concept. Then we are also looking at the number 8, the dual aspect concept. The dual aspect concept. two aspects of the accounting, one representing by assets of the business and other by claiming against them, liability. So we have the liability and the asset part of it. The liability part of it. Now, I used to say to students that it's not all the liabilities that we talk about that are all liabilities. There are also liabilities that bring forth money, liability that releases money into people's hand, that people begin to enjoy, the money. So liability most of the time is not really a loss. Sometimes they are liability. For example, if you borrow money from the bank, you borrow money from the bank, that is not a loss, that is not a liability, but it's a liability that brings money into the accounting system. Then we also look at the next one is the accrual concept. The accrual concept. When we talk about the accrual concept, then we are talking about that fact that that net profit is different between revenue and expenses, or cash receipt and expenditure, is known as accrual concept. What we are saying is that your profit, to determine your profit, is your asset minus your liability. That means what comes in, your income minus your expenses. Now, if your expenses is too much, it's more than your income, what we say to you is that you are owing. We talk about the accrual part of it, that is owing, or there are money that you're supposed to have paid, your dues you're supposed to have paid and you didn't pay, they are called the accrual. And so we need to understand this money, that the mechanism needed is called matching expenses against revenue. You match your expenses against revenue. What you get gives you the straight point of what you really need. Then we look at the convention of accounting. Let's quickly look at convention of the accounting. What is convention of accounting? Concept of accounting have become accepted in the business world. Assimilation having taken place over many ways. The concepts, however, are capable of being interpreted in many ways. What has therefore grown up of an accounting are generally accepted approach to the application of the concept to know as convention of accounting. So we say convention is a general acceptable principle. Let's hear that very well. Convention is a general acceptable principle, method, rules of behavior of accounting. We say concept is a general accepted principle, method, rules, or behavior of accounting. Behavior of accounting. So no matter how you know how to do accounting, there's always a formula, there's always a principle, there's always a way of doing the account, and that is called convention. It's called convention. So we say it's a conventional way of doing accounting. So there are times I always have problem with some of the students, when we are treating account, they say, okay, this one is on the debit side, it must go on the other debit side. No, that's not what accounting is being done. Accounting can start on the debit side and end up on the credit side of the accounting. Then we have some accounting conventions, and one of them is called the material concept, the material concept, the material convention or concept. Now, what is that material concept? We talk about that it holds that only item of material values are accorded their structure accounting treatment. So if there's a material that has no value, and I have told you that the value that is given is the value of what is the value of money, is price. Money is added to the accounting. So if money is not added to the accounting, then there's no way we can match the price of the things with what is coming up. We can't match it. So we say purchase of a cheap metal ashtray will be changed as expenses in the period it is bought. So the period that thing is bought, we call it the period of expenses, the expenses period. That's what we call it, and that is called the material concept. Then we also look at the prudence concept. The prudence concept. Now, this prudence concept in a convention, demand great care in the recognition of profit, while all the losses are adequately provided for. They are provided for. It's not a justification for the creation of secret or hidden reserves. It's also referred to as convention of conservation. So prudence convention is also called the conservation conservative concept, conventional, also called to make sure that all losses are recorded in the book. Now, because of our time, I just want us to have these questions. Let's write these questions down. Number one, state the fundamental accounting equation. Number one, state the fundamental accounting equation. Number two, what are the basics? What are the basic assumptions underlying the periodic financial accounting of organization? Two, what are the basic assumptions underlying the periodic financial accounting of the organization? Then the last one is, what is the Nigeria Accounting Standard Board? What is the Nigeria Accounting Standard Board? Number one question is, state the fundamental accounting equation. Number two, what are the basic assumptions underlying the periodic financial accounting of the organization? So we need to send those questions. And the third one is, what is the Nigeria Accounting Standard Board? What is the Nigeria Accounting Standard Board? So you need to send that to my Gmail. My Gmail is gioba2804@gmail.com. Gioba2804@gmail.com. Gioba is GEOGBA 2804@gmail.com. The business document that establishes the existence and credibility of a transaction, and they include, we'll call them, possibly just look at them. Let's look at them. Number one is invoice. We look at invoice. We are looking at invoice. What is invoice? Invoice could be defined as a statement showing a description of goods sold, their quantity and prices, with a note of the terms of agreement. Invoice. We talk about invoice. Invoice could be defined as a statement showing a description of goods sold, their quantities and price, with a note of the item of agreement. That's an invoice. Then if you look at the invoice, you will see that we have the names of the business, the names of those who are buying. We look at the particulars of what the names that are given. Number two, we are looking at receipts. We look at receipts. We are looking at receipts. We are already in source of documents. We look at receipts. So let's look at what receipts are. What receipts are. Receipt is a business document used as evidence of payment for goods or services bought or rendered. Receipt is a business document used receipt is a business document used as evidence of payment for goods or services bought or rendered. Now, under receipt, you have a statement, you have the receipt number, the invoice, and so many things from the receipt. Then we also look at the credit note. We are looking at credit note, and credit note. Credit note is defined as a business document sent by the seller to the buyer to correct and overcharging on the original invoice. Credit note is defined as a business document sent by the seller to the buyer to correct and overcharge on the original invoice. What we are saying is that a credit note is sent to the owner of the business, and that shows to us that that business picks up and it's is over an overcharge that's credited. Then we also move on to the next one, debit note. Now, if credit note is an overcharge, then we need to know that a debit note is undercharge. He said debit note is referred to as the supplementary invoice and consequently treated the same way as an invoice is treated as an way as invoice. It is usually prepared whenever it becomes necessary for one reason or the other to increase the amount due from a debtor, to increase the amount due for a debtor. Now, we also look at the next one is the check. We look at the check. What is the check? According to the Bill of Exchange Act 1882, a check is described as a bill of exchange drawn on a banker payable on demand. Drawn on a banker payable on demand. Statutorily, a check is defined as an unconditional order in writing. An unconditional order in writing, addressed by customer to his banks, to his bankers, instructing the bank to pay on demand a statement sum of money to a specific person. So when we talk about check can be used. Now, if you are not running a current account, you cannot use check. So check is given to somebody to withdraw or ordering the bank to pay a specific amount of money to a certain person. That is when you issue out a check to people. And we have different type of checks. So the man, a drawer is termed the person who signed the check or an order to pay. A drawer is the bank who is expected to honor the check. Then payee is the term, the person who is entitled to receive the money. So check, and I've told you check, they have different types of check. We have cross, different type of check. We have cross check, we have open check. Then one way you can open your check, to open check for people, is by signing on top of the check. You want to open it. And if you are not running a saving a current account, there's no way that you can draft a check. You can't draft a check until you run a current account. Now, we also look at the statement of account. What is statement of account? Statement of account. Periodically, business organizations send out claims for money in settlement of goods sold on credit. That is, goods for which immediately or cash payment was not made. So statement account may not even only be given to people who buy on credit. Statement of account is also used for people, for a bank. You can order for your statement of account, and that is to know your credit and your debit. Possibly people paid money to your account and you don't know or you've forgotten. They will print everything out you'll be able to differentiate between what the money you have and the money you are owing, or the money you have ordered the banks to pay for you too. So we talk about that as a statement of account. We talk about statement of account. Then by next week, we are going to look at the subsidiary books, the subsidiary books, the subsidiary books. But before next week, since we have a little time, well, let's look at what the subsidiary books are. Subsidiary books, otherwise called dairy or original journal, are the background upon which the ledger is based. In that entries are firstly made in them before posting or recording them into the ledger. Your subsidiary account, we can thus say that they are original journal. That means your journal is your day-to-day, business, what you sell on day-to-day. You sell one thing or the other on day-to-day, and that's where the journal comes up. The journal comes up. Then we also need to know that there are different types of journals. There are different types of journal. So when we talk about subsidiary books, we have different types of subsidiary books. We have the sales day book, we have the return inward journal, we have the return inward journal, we have the return outward journal. Then we also have the purchases journal. We have the purchases journal, and we also have the ledgers. We have the ledgers, and all this will be treated next week by the time we meet. And I know that you will go home and do some research on this account. Then we'll now later move on to another aspect of the lecture. So, but don't forget my assignment for next week. Submit before next week. The assignment: state the fundamental accounting equation. Then, what are the basic assumptions underlying the periodic financial accounting of organization? Then 3, what is the Nigeria Accounting Standard, board? What's the Nigeria Standard and Nigeria Accounting Standard Board? So you need to Google that so that we can know what the answer is. But prior to next week, by the grace of God, we'll see you next week, and we'll start from the subsidiary books. The subsidiary books. What are the subsidiary books, and how to enter our subsidiary books? Thank you very much. Then we'll see you next week by the grace of God, because of our time. Thank you.